Who knows what a private money loan is? That's it? Okay, so have you ever heard of a hard money loan? Okay, so basically a private money loan is the same as a hard money loan. It's just a better way of saying it. It sounds a little better, so that's why we use that term, or I like to use it. Now let me just give you a little background on myself. I grew up in Minnesota, hated the cold weather, came out when I was 6 years old, started moving west. And we ended up here in Los Angeles, and then I grew up in Orange County after that for 20 plus years. So when I got started, actually, when I was 10 years old, I watched my dad. He was an investor in private money loans, and I saw him. I would ask him, "What are you doing?" And he would tell me, but he would like to chase high yields. So he would do like third, fourth, fifth trust deeds on apartment buildings and other things. And guess what happened? He got burned. Yeah, and he learned quickly that the collateral and your position in line on the collateral is the most important thing. So once I got into college, I started dabbling in private money lending, but I did it with commercial properties. I started, buying gas stations in California and Arizona, other types of commercial properties, and I'd lend on them. So that was my introduction to getting into the business. So most people start the opposite. They'll do residential and then get into commercial later. I did just the opposite. So I get an old gas station. I build it up, clean it up, fix it up. I'd put a business on there, and then I might sell the business, keep the real estate as a rental, and then eventually, I would sell the property also. So that kind of got me going. And the other thing I would do is I would sell old cars, classic cars, antique cars, muscle cars. So I did that, for several years. I owned over 300 classic, antique, muscle cars during this period of time. And so I'd buy one, I bought a shop, I'd fix them up, sell them, buy another one. Sometimes I would buy 3 or 4 a week, and I'd ship them all over the country, Canada, Texas, you name it. And I even bought a paint booth. I would paint the cars. I learned to paint. So that was really good for a while. And then all of a sudden, my health started to deteriorate. And I went to the doctor. I had problems breathing. And the doctor said, "What do you do for a living?" Well, I work on cars. I smog cars. I paint cars. He said, "Well, the fumes that you're dealing with, and way back when the laws regarding painting and all that exhaust, it was different. It wasn't like it was now." So he said, you need to find a new line of work or you're not going to last too long. So I liquidated all my car businesses and everything, and then I just focused on the private money lending. So, I started with the commercial, then I started doing, the residential. And, it just kind of grew from there. And then 10 years later, I started focusing too on conventional loans and other types of lending also. So getting back to the screen here. Let's see. Okay, so what are private money loans? They're basically loans made outside of a bank or institution, and typically made by individuals who use their own personal funds or funds of other individuals to create a note secured by real estate. So why would anybody go to a private money lender than a bank? Who can answer that question? Yes.
Because you could talk to people.
Okay.
You can't really talk to the decision maker at the bank.
Okay. And what's another reason? Okay. So, when you're dealing with private money, what's the most important thing the lender looks at over everything else? Does anybody know? I'm sorry?
Ability to repay.
No. That's the second reason. What's the number one reason?
Collateral.
Who said that? You. Oh, you're going to get a special prize for saying that. That's it. That's the number one reason, collateral. Secondly, ability to pay. Those are the two most important things. If you have a piece of property and you want to get a loan, what does the lender normally want? He wants you to put a down payment down, because if there's a default, he has some security there. Now, there's a lot of private lenders that will do what we call 100%, even more than 100% financing. Well, there's a cost to pay for that, because if you're getting, let's say, 125% financing with the fix and flippers, you get the whole purchase covered, and then they want the whole rehab covered, which is fine, but it comes at a greater cost. Sometimes they want equity in your deal. Sometimes they're going to raise the rate, raise the fee, but you are going to pay more in some ways. The more money you have of your own invested in the deal, the better deal you're going to get. Does that make sense? Okay.
Steve, we do have some new people in the audience. Could you briefly explain what a note is?
Okay. So basically, the note is what secures the loan. It has the terms on it, the interest rate, the payment, how long it's going to be for, if it's going to be a year, 3 years, 5 years, what have you. Is it going to be amortized? Does everybody know what amortization is? Can somebody explain amortization? Nobody knows what amortization is.
The loan pays off over time.
Okay, the loan pays off over time, correct. So sometimes you get an interest-only loan. Then you're just paying interest. What happens if you get a 3-year loan interest-only? What happens at the end of 3 years? You got a balloon payment. You're going to pay it all off. Is that dangerous? Sometimes. Why is it dangerous? What if you don't have the money to pay it off in 3 years? How are you going to get out of it? Are you going to sell the property? Are you going to refinance? What are you going to do? What's your exit strategy? Now, if you're getting a short-term loan, let's say a 3-year loan, amortized, it probably won't work for you because payments would be sky high. So most people, they're going to get a loan and it's going to be partially amortized, or maybe it's interest only. And dealing with private money, you most likely will have that balloon payment. So you got to think about, what's your exit strategy? Are you a flipper? Are you a buy and hold? A lot of times people will buy a property and the condition is not that great, and you go to the bank and say, hey, I need this loan, but I need to close in 7 days. The property's a disaster. When can I get my money? And the bank looks at you very quizzically and said, I'm sorry, that's not a deal for us. So what do you do next? You start calling people that are not banks, and you say, hey, I need a loan. Here's a property. It's in bad shape. I got to close in a week, and I need the money. What do I do? And the person says, here it is. I recently did a loan for a club member. That person was buying a property in very bad condition. It was 3 units, and the seller gave them 7 days to close. And the seller also requested, I don't want you to get a loan. Didn't matter what kind of loan, private, bank. Said, no, I want cash at the end of 7 days. So what did the person do? They called me and said, can you help me? And I said, sure. And this is a previous customer. So what I did, I said, well, since we can't do a loan on the subject property you're buying, what else can you put up for collateral? Well, I have this duplex here in LA. It's free and clear. I said, what's it worth? $1 million. Okay, you're approved. That's it? Yep. Are we doing an appraisal? No. Are we doing any? No. I know you. I trust you. Yeah, I'm going to probably run your credit, but that was it. So we went ahead. We did, again, our note and our deed of trust. And for you that don't know, deed of trust is basically what you record against the property for the lender to have security. It does not tell you all the terms. The note is what determines the terms, but the deed is what records against the property. So we did that. It took 5 days. We closed that loan, and then she had to take that money with money that she had in savings and ran over, gave it to the escrow for her other deal. She closed basically in a week, and that's how she beat out everybody else on this property and probably picked up, I want to say, a couple $100,000 in equity on the deal. How did she do it? Because she knew where to go for the money, and we could do it quickly. So those are the opportunities that you have to take advantage of, and that's why the private lending can be a good way to go. Yes?
Also, I would think that an institutional lender will not give her the money that quick.
That's right.
A lot more requirements.
Right. Going to be a lot more requirements. They want an appraisal. You know, they may want other things. They're going to want her taxes. And this person, you know, self-employed, doesn't show a lot of income on her taxes, but she owns like 25 properties. She's got the ability to make payments. She's got good cash flow. And for a private person, that's all we really care about. And again, the collateral. So it was a make sense loan. And as she closed on her deal, 30 days later, she paid me off. And since I never have prepayment penalties on my private loans, it worked for her. If she went to a bank and got a loan and tried to pay the bank off a month later, guess what? The bank's going to charge her a huge prepayment penalty, right? You know, no bank wants to get repaid in a month. Me, okay, fine. You know, you had use of the money. I get it back. I can lend it to somebody else. So that works for me. It works for the borrower. It's a win-win situation for everybody. Okay, so again, why do private money loans? Why are they beneficial over a bank or an institutional? You know, there's certain criteria, the condition, property condition's bad, banks aren't going to normally touch it. And I do conventional lending too, and I've got several conventional loans, and it's unfortunate, but I have to make people do tedious work to make sure that building is going to be okay before the appraiser comes out there, because if it's got termites, if it doesn't have smoke detectors, carbon monoxide detectors, the water heater is not strapped, whatever the case may be, we're not going to get the loan through until those things are rectified. So with private money, we don't care. You know, I mean, I've done loans where the house is basically gutted on the inside. It's all right. Is the overall collateral worth it? Yes. Then let's make the loan. So, you know, where the bank's going to look at, the documentation of the borrower's income, the credit, sourcing of assets, where are you getting the money from? They want to see 2 months, in the bank. Otherwise, they're going to say, where'd you get all this money? The collateral, is there sufficient equity? So all those things. And then the time frame. Normal loan time on a bank loan could be 30 to 60 days. Well, those of you who find these deals, sometimes you have to close really quick. So that's not going to work. But you can get the private money done, and then afterwards you fix it, you stabilize it. Maybe you buy a vacant building, you put some tenants in there, and then you cash flows. Now you can go to the bank, you're under no time pressure, and you can get, a regular loan. And that's the way to go. What kind of properties are used as collateral for private money loans? Now, the biggest key here is we like to do non-owner occupied loans. Does anybody know why that is? Besides you, I know you can answer every question, but anybody else? Okay. No. Anybody else?
You were saying the back building?
Yeah, say it a little louder. That's right. So back a few years ago, the government decided we have to have more regulation on these loans, especially after the fallout of 2008. So some congressman came up with what we call Dodd-Frank. So it was basically a way for get people to jump through more hoops, but especially for the lenders, and it made it literally impossible and illegal for anybody to do a private money loan on an owner-occupied residence. So they felt that nobody should be kicked out of their primary residence if they can't pay, or the failure to pay. So that's why if you did get a private money loan and you're an owner-occupied resident of the property, you could literally go to any attorney and he'll be licking his chops and say, oh, you don't want to pay the loan back? Don't worry, I got you covered. And they'll take you to, the lender to court, and guess what? The judge will rule in the borrower's favor. Doesn't matter, I don't care what the circumstances were, the judge will say, this case, I'm turning this into a personal note, so now if you want to collect, you're going to have to go after them personally, but you have no lien anymore on the property. That's why I knew of one company that would do owner-occupied loans, super strict, privately, and they don't even do them anymore. So that's the key there. So anyway, we'll do private money loans on SFRs, multifamily, commercial, mixed use, industrial, self-storage facilities, mobile homes on land, hotels, motels, and even raw land. So if the value is